stock bulls are still in control, but they really achieved the minimum this week. Nvidia's big breakout with a sell-off on Thursday. We recovered it by Friday and had a nice bounce back, but not entirely considering where we were when it looked like we're going to open up Thursday. So it was a reminder here that the market is kind of limited in a few of its major narratives. One on the macro side, the other one on the micro side. So first, just technically where we are. Yesterday's candle was indeed a pretty dramatic one, but we held up in the range. So between the 5,300, basically give or take about 25 points, still held out above the old highs. So that's the victory, and that's the way it should be described. Trend is on. We consolidated. We went sideways. Bulls stayed in control. Now, it's a bit of an ominous candle to deal with next week, but at least we didn't follow it through with downside today. Now, where we did run into a little bit of a wall was the notion of broadening out risk-taking appetite, both in crypto markets and in the lower quality equities. Let's use the Russell as the proxy for lower quality. And once again, we saw 2100 was a brick wall, basically, the line in the sand for the Russell. Rejection again from the last time we tried to get through there. Blue line being the Russell. Last time we peaked out for a moment when we got above 21, it didn't last. And then we had the April drop. For Bitcoin in the white, we still are putting in lower highs. We got a nice bounce up off of the April lows, but for BTC, you're still basically dealing with a pretty standard downtrend off the highs. So we got the Ethereum news too. Ethereum popped, but it still was below its old high, which was below its all-time high. So the crypto markets are just a little bit more sluggish, even with good news generally and risk on. With the breakout in Nvidia, you didn't really see it translate into the rest of the market. And I think it's a reminder here that we have some limitations on to the extent we can broaden out the rally. The reason we have limitations on lower quality groups like the small caps or the crypto world is because there's only so much risk taking that investors are willing to do right now. And they want to do it in the places where there's real growth, there's real product, there's real profit. And what we saw on Nvidia's earnings is that that's all getting sucked up basically by Nvidia. We'll have to see how the cloud companies do, but so far those earnings weren't very well received with Intuit and what we saw for Workday as well. So it's going to be a little bit of a tough road, it seems, right now. But the overall general backdrop in the market overall connected to the economy actually wasn't terrible because we got a good piece of recovery data in the PMI. And even though stocks didn't like the PMI, it still is the better problem to deal with. Data coming in too hot is still the preferred problem, okay? Data coming in cold is when we should get really worried. What we've got is data coming in hot, but that does then require a little bit of sleuthing on the macro side, because if you look at the bond chart for the 10-year, I think it has actually made a meaningful move this week, and I'm going to kind of loosely draw this, but the old uptrend for the 10-year that gets you somewhere around like 4 or 5. This is why it was a big deal when the 10-year broke down on CPI. That's what happened here. Well, now we've basically recovered it, and we're pretty much back on the uptrend line. So because of the 10-year's rise this week and the fact that we erased the rally for bonds after CPI, that's what really happened here. We had the rally in bonds, dropped the yield on the CPI earlier this month, and we've taken it all back since. And that tells us the economy is on a little more solid footing. Remember, we had a couple really bad weeks in the beginning of May on the economic data. We had some really ugly prints. So the PMI this week was a nice sign that the economy is still functioning on the services side, but it is going to produce some inflation still. That doesn't have to be a problem for stocks right now, but I think it does mean that we need to revisit where bonds are on the risk radar. My light there has been green after we had the breakdown in yield, but I think it looks more like it's neutral. I think the yellow light needs to go back on because with the data next week, the fact that we've taken back the gains in the bond market post CPI means that if any of the numbers next week come in warm, bond market's ready to sell off again. And that's the main takeaway from the macro side. For stocks, it's all about Nvidia. We have to see if the other tech companies can show something similar. The cloud companies and some of the other hardware stocks that are still left to report have got to give us something because we barely made it through this week. We squeezed it by. That's enough for a victory, but it's a very small one. Not quite a Pyrrhic victory, but still a small victory. Enjoy your Memorial Day.